Hello everyone, welcome to Demand Supply Trading Practical session number 41. Today's session is again our practical session, but we'll also be touching upon the the stock market that has been moving down for the last few weeks. In fact, this week also we had a really strong bearish market. But yes, the question will be when the stock markets they crashed, did the demand supply zone still hold for us? So we will be looking at some of the examples that we analyzed in the past. Because we always start with the review of these trades, and that will give you a little bit of understanding how beautifully the demand supply methodology works. Obviously, every trade is not going to be a profitable trade. We will have winners, we will have losers, but the thing is, by seeing the before and after, right, what we planned and what happened eventually, that helps you build up confidence in the methodology, and that is the basic idea behind these sessions. And that is also the beautiful part of these sessions, that whenever we are looking into our practical sessions, we are planning our trades well in advance, right? We are planning our examples well in advance. So as we move ahead, we'll again talk about it, but let's get started with the basics first. So myself, Srijit Kakkar, today is Sunday, 27th of October, 2024. And also ensure that you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you regarding our upcoming sessions, upcoming videos, if we have any offers, and on and off. I also keep posting some tips and tricks regarding trading, or even regarding demand and supply methodology. So if you want to join this channel and you've still not joined this channel, you can scan the QR code which is available on your screen. Otherwise, the link is available in the description. You can click on that link and join that Telegram channel if you wish to. All right, now talking about today's session, it is going to be practical application of demand supply methodology. So our demand supply course used to be a paid course, but now available 100% free to everyone. So if you have still not gone through the course and you want to learn demand supply methodology, the links are available in the description. Once you go through the course content, you will be learning the methodology theoretically. What is demand supply, how to identify zones, how to qualify zones, right? All those things have been covered theoretically, uh, when it comes to the process of from the starting to the end. Now the problem is, yes, once you have gone through the process theoretically, unless and until we look into some practical examples, we don't get a very good understanding of how it has to be applied. And that is what I do in these practical sessions. So every weekend I do a practical session where we take some examples, and to those examples we apply the complete methodology, so that you can learn how to use the strategy in planning trades very rule based, very mechanically. Now the best part of about these sessions is that whatever examples we are taking, we are not looking into something which has already happened and just simply reviewing it, because every time I talk about it, that something which has already happened, justifying it is very, very easy. It's a piece of cake. You can pick any indicator, you can pick any oscillator, you can apply it on the charts, and you can find a number of reasons why you would have participated in that move. But the problem is, in real markets, those I'll say lagging indicators, they don't help, right? So when we have to make our decisions well in advance, where I would like to be a buyer, where I would like to be a seller, that is where the demand supply methodology aces, and that is what we do in these sessions. We plan our trade examples well in advance, and just because I'm planning them in advance does not mean that we plan them and then we forget about it. So we are planning them in advance, and eventually in the future, when those trades they get triggered, we also review them, and that helps you look into both the before and the after, and that also helps you build up confidence in the methodology, which is the basic idea behind these sessions. Because unless and until you build that confidence, you will not try to learn that methodology. You will not try to, if you're doing something else, you will also not try to shift from it. Now I'm not saying you have to shift from it. If even if you want to use it as a confluence along with whatever you have been doing, at least you'll get that confidence that yes, maybe I can use it as a confluence as well. So in all those aspects, it definitely helps you, and that is why I do these practical sessions. Now, starting with the examples which got triggered for us in the past or during this week. So once we are done with the review of it, then we'll start with our example for today. So the very first one, let me load it for you. So just give me a second. So now this one is getting carried forward. Just hold on for a minute. Let me bring that up. All right, so this is from session number 36. We did the analysis on the 22nd of September and prices came back into the zone on the 8th of October. Yes, we definitely traded in this zone for quite a few days, but eventually prices they started moving down. And now this would be closed as a stopped out trade, right? So session number 36, which was getting carried forward for us, is now closed as a stopped out trade. Now moving on to the next one. Now this one is also getting carried forward. So just give me a second. Let me bring this up. Right, so this one is also getting carried forward. So we talked about this. We did the analysis on the 24th, which this is session number 24th. We did the analysis on 23rd of June, and you can see prices came into the zone on the 8th of October. Now, last time when we did the review of it, we talked about that yes, we do have an opposing zone. At the violation of that opposing zone, we can trail onto it. But that opposing zone, which is right here, was not violated. Therefore, our stop loss was still at break even. So your stop would have still been at break even, and eventually the prices they came back into the zone, and now you would be out of the trade as a break even trade. Otherwise, it did give us a move which was approximately 3:1, if not exactly 3:1, was about maybe 2.8, right? So if you have some rules where you want to book some partial profits, you could have booked some partial profits on this. Otherwise, not a stopped out trade, would be a break even trade for us. But the zone is still holding. You can see we again came into the zone, again got a bounce, which is about 1:1, but the zone has not yet been breached. So these two were getting carried forward, and now we are closing both of these, one as a stopped out and the other one as a break even. Now, moving forward with the few examples which got triggered this week. So we have 4 examples which got triggered this week. So now let's do the review of them. So the very first one is this one. Just give me a second. Right. So this is from the last session. In the last session, we did the analysis. So last session was session number 40. And we did the analysis for this on the 20th of October. And you can see prices came into the zone on the 21st. And the very next day, we gapped up. We have 1:1, 2:1, 3:1, almost a 4:1 move in just one day. So you can see that even though the markets were crashing, it gave us a 4:1, almost a 4:1 move before we again started moving back into the zone. Now, talking about your reward to risk ratio, it would have not been a challenge because if I do a candle replay, you can see at the time of entry, which is this candle, our opposing fresh zone is here, which is only showing us a reward to risk ratio that is about 1:1. In fact, less than 1:1. But the fact is, when we did the analysis, we were planning the trade at the best location. So here you can see we are planning trade at the best location. And if you go through the rule book, the rule says that when we are planning our trades at the best location, just give me a second, at the best location, our targets can be from the intermediate time frame. So if I go to the intermediate time frame, in this case it is going to be the weekly chart. So you can see on the weekly time frame, if we are looking at our fresh opposing zone, it's pretty far away, which is showing us a reward to risk ratio that is maybe uh, 10:1. So reward to risk ratio was not a challenge. We could have participated, but what happened, we got a move which was about 4:1. So you would have only got the opportunity to make it as a break-even trade. Then we again came back into the zone. You would have been out of the trade as a break-even trade. Yes, if you wanted to book some partial profits because you definitely got a really nice move the very next day. So again, partial booking could have been done, but I'm going strictly with the rules that we have in the rule book. Which is a very conservative approach, which would have led this to be a break-even trade for us. So this will also be closed as a break-even trade. But again, I'm just showing you the beauty of demand-supply methodology. Can you see even when the markets were crashing like crazy, we got really nice moves from these areas. In fact, if you talk about this in terms of percentage, in about just a one day, you got a move which was somewhere close to 16.5%, right? If you talk about the high. Now, if you wanted to book some partial profits, let's say at 2:1s or 3:1s, that could have been done. But again, I'm going with a very, very conservative approach. And we will be marking it as a break-even trade based on that. So that takes care of this one as well, which will be closed now as a break-even trade. Now moving on to the next one, just give me a second. The next one is, all right, just a second. All right, so moving on to the next one here also, if you talk about your reward to risk ratio when the prices came into the zone, you can see we do have an opposing zone here, but it is already a tested zone and we'll never be taking a tested zone as our target. So when the prices came into the zone, our target was close to 3:1, but now the problem is We didn't get the opportunity to make it as a break-even trade. Prices again came deeper into the zone. Now we also have a formation of a zone which is spoiling our reward to risk ratio. Now the best thing I can do is first check where am I located, and in this case as well, we are located at the best location. You can see we have a monthly zone. We are planning a trade inside of it. So at best location, I can again take my target from the intermediate time frame. But again, the problem is that the closing of the weekly candle also created a weekly supply area for us. So now we know the best case scenario is I can only have a target which is as good as break even. So the only thing we can do is revise our target to a break even point, which is where our entry is. So in case on Monday, which is tomorrow, prices they move up, break even, we can exit from it. If it continues moving down, it can also end up as a stopped out trade for us. So this will remain as an open trade. We'll track it for the next few weeks and see how it works out for us. The next one is this one. Just give me a second. Let me also open the next one. All right, so this is from session number 33. The analysis was done on the 1st of September. This was again a type 1 trade for us. Now, the problem with this one is that you can see when the prices came into the zone, we just have a zone sitting right above, which is basically killing our reward to risk ratio. We don't even have I mean, don't even have a 2:1, but it's as good as just 1:1. So 1:1 is something we should not be trading for. Again, we can check where we are located on this one. And in this case, we are not planning our trade at the best location. So since we are not at the best location, the target has to be from the lower time frame, which is just about 1:1. And as a rule-based trader, we should never be taking trades for such small reward to risk ratios. So this would have been an invalid trade for us. But you can see prices came a little deeper into the zone. The stop loss has not yet been breached, and on Friday again we started getting a move out of the zone now. But the problem is because of reward to risk ratio, not a valid trade for us, so this would be skipped. And the last one which got triggered is this one. Let me also bring this up. Now this is from, just a second. So this is from session number 29, which was on the 28th of July. And you can see we came into the zone on this particular day. Now the problem is, you can see, when we planned our trade, prices have already moved pretty far away before they started coming back. So at times what can happen is maybe the prices hit the very high of the curve and then started coming back, which is definitely somewhat the case, because you understand when we do our curve analysis, we do exactly the same thing. If you don't have a zone, we take it as a reference point. But let's assume because we don't have a zone here, we are still looking into participating in this trade. So in that case, what would be my reward to risk ratio? You have just close to 2:1. So let's assume I'm okay with that, because this is as good as 2:1. So considering it as a valid trade, you would see that if I wanted to participate, this would have been a stopped out trade for us. So we'll consider it as a stopped out trade. Though there were a few challenges. One, we have already got a really nice move to the upside before the prices they started coming back, which is almost like we are almost hitting the most recent high, and from there we are correcting. So that is where you could have been a little bit careful. But yes, let's assume we were ignoring all those things and strictly leaning against the zone again to take a trade, and assuming that this is exactly a 2:1, though it is a little less than 2:1. We'll call it as a stopped out trade. So again, looking at we looked at about 4-5 examples. So you can see that the demand areas that we marked, most of the times the zones, they stopped there before moving against us, or they gave us nice bounces. We got 2:1 bounces, we got more than 3:1 bounces, we got bounces which gave us the opportunity to make it as a break even trade. So the zones, they definitely held. It's not that in every case prices they just went right through it. Now the other thing I'll also talk about is that my challenge is that I only trade the NSE cash market, and in cash market I can only take long trades as overnight trades. I cannot take short trades as overnight trades. So my problem is, my challenge is that my hands are also tied, that I can only participate in one side of the market move, which is the upside. I can't participate in the downside. But yes, those of you who are trading futures, if you were planning some short trades, so just imagine when the markets are falling like crazy, the demand zones are still working nicely. What if you were also planning short trades? They would have worked beautifully. Now, if you even look at this example, can you see we hit our supply, and that is where we got this move all the way to the downside. So yes, it's not that if the markets are falling, every demand zone will get violated. Yes, if your challenge is that you can only participate on one side of the market, you might have few extra stopped out trades during that week or during that month. But if you're selective, it's not going to happen with every other demand area. Like you can see that in these examples, most of them worked really nice and beautifully. Some of them which also got stopped out, they definitely were holding the price for quite a longer period of time before those zones they also got violated, which again, like I say, different traders, different personality style, different rules. I have seen people with rules like that. If the price stays in my zone for X number of candles, I'll close my position, right? So instead of being a stopped out trade, it could have been a trade where you could have been exited break even or maybe small little loss. So all these things, when you make modifications to your trade plan, can help you, can assist you. But I'm just showing you, wherever we are planning, it's not that if the markets are crashing, everything is just going right against us and all those zones are getting stopped out. And some of these trades, which, like I said, we were doing a little conservative approach. If you were doing some modifications, you could have booked some partial profits. Maybe you might still be in some positions where you might want to trail eventually, and that might start happening from maybe the next week or maybe the next week. So yes, just wanted to show you these examples that yes, people believe that when the markets are crashing, everything is gonna get stopped out. But that's not the case if you are understanding how to find key quality areas versus just trading on any demand area or any zone that you see on the chart. All right, so that being said, let's get started with our analysis for today. So just give me a second, let me bring up the chart for today, and then we'll do our analysis. Perfect. So great, whenever we talk about trading, always say trading has to be a very mechanical and rule based process. And I know it's easier said than done. So how do we make our process mechanical and easier? For that, definitely you need to have a good enough experience of whatever methodology you're applying. But I do understand when you're learning trading as a fresher or when you started learning a new methodology, it's not easy to create a trade plan from day one. And to help you with that, I have created a trade plan for you, which is a combination of two documents. The first one is your trade plan steps. You can call it as the flowchart or the walkthrough, which guides us what we need to do as a demand and supply trader, step by step. And the second one is your rule book, where you will be able to find all the rules in context with the demand supply methodology. Now, this rule book is a conservative approach. With time, with experience, you can make modifications to it to make it better suit with your personality style. And yes, like I was saying, that as a trader, we need to be mechanical and rule based. Now, why we need to be mechanical and rule based, I have also explained this in a video. And the title of that video is How to Start Trading. The link is available in the description. Again, I'll add whenever I'm talking about some documents or some videos, all the links are available in the description. Go through the description, you'll be able to find all of them. And some of these files you will also be able to find them on our Telegram channel, like the rule book, flowchart I've already shared there. So if you'll just scroll back in that in that channel, then you'll search for, let's say, the rule book or the flowchart. You'll be able to find them and you can download it from our Telegram channel as well. All right, so yes, talking about we need to be mechanical and rule based. So what is our step number one? Step number one is we need to define our trade purpose. And what do we mean by trade purpose? Trade purpose basically implies my expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why do we start with our trade purpose as our step number one? And the answer to this question is, see, whenever we are doing our analysis, the charts that we are using, they are time-based charts, and we have a number of time frames available to us. So out of these a number of time frames, which time frame should I be using for my analysis? That is also something which has to be very mechanical and rule-based. And the logic that we follow for this process is that the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So that is why we decide our trade purpose as our step number one, so that once I know what kind of trade I want to participate, I can use time frames which can help me in planning those kind of trades. So what I've done is I have divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I say daily income is a trade which can last for a day or few days. But everyone understands that whenever you are trading markets which are not 24-hour markets, example, if I talk about the Indian NSE market, it's not a 24-hour market. And whenever the market opens, you would have experienced some of these symbols. They gap up, some symbols they gap down. And because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we do understand that holding a position overnight definitely has its own pros and cons. Pros everyone will be happy with, but the downside, if you get a gap against you, you can lose more than what you were willing to lose. That is gonna hurt, and that is why my recommendation is that initially our hourly dailies should be done strictly as intraday trades. We don't want to take that unnecessary overnight gap risk by keeping them as overnight positions. For weekly monthlies, anyhow, we are not expecting to get the exit the same day. So here we have no choice. We'll have to keep those positions as overnight positions. But with time, with experience, once you start building up confidence in your analysis, you want to include daily incomes into overnight. That can be done. Initially, as a risk management rule, don't do them as overnight trades. So my step one is I need to define my trade purpose. Let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen from the rule book, I'll get to know what time frames I should be using. Now, demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits, and the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 trade different purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question is, for every purpose of trade, what will be my 4 different time frames? And you get the answer from this table. Like in this example, I want to plan monthly income trades. So now I know as a monthly income trader, my time frames will be monthly, weekly, daily 60. Monthly will be the higher time frame, which will be used for curve analysis. Intermediate will be weekly, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss entry target and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine-tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules. That is also where this time frame can help us. Now, mind it, this table, which is on page number 31, is specifically for the NSE market because this is only open for 6 hours, 15 minutes during the day. Now, if you're trading markets which are open for longer duration, you can refer to the table which is on page number 32. This can be used for commodities, forex, cryptocurrencies, right? So wherever markets which are trading for longer durations, you can refer to this table. All right, so now coming back to step number 1, I defined my trade purpose. I want to plan monthly income trades. So now I know what time frames I will be using for my analysis, plus what analysis I will be doing on each and every time frame. I have clarity to it. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but if we take the example of NSE, it has over 2000 plus companies listed on it. So humanly not possible that every day I sit and analyze 2000 companies. So what we need to do now is we need to have a process in place for selecting scripts. So I need to have a process which can help me get a smaller list out of these 2000 companies, because if I have a small list, I can do my analysis almost every other day. But if I have to go through 2000 companies every day, not an easy task. So how do I get my smaller list? So the way we do this is by using certain computer programs which are called as scanners or screeners. So the way these computer programs they work is we input certain conditions into them, that these are the conditions I'm looking for, and then the computer program identifies that out of these a number of symbols, which symbols are matching with those conditions. Whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, very, very important thing which you always have to remember, irrespective which scanner or screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell these symbols or these stocks. These scanner screeners, they never tell you what you need to buy or sell. They only help you get a smaller list out of a bigger list. And once you have that smaller list, then you will have to analyze them manually one by one and see which one matches with your trade plan. The one that matches with your trade plan is your opportunity. The one which doesn't match with your trade plan, you simply skip it. Now, few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created some scanners for you, which are based on some moving averages. They can help you in shortlisting symbols. Second example, if you go to my YouTube channel and search for scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll also be able to find a video on top-down analysis. So these are 3-4 different examples of scanner screeners, but you're not restricted only to them. So let's look at few examples before we move ahead. So like I was talking about, that once you go to our website, under the free tab, you have option stock screener. Because I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting 2 symbols for me, but like I already said, just because I'm getting these 2 symbols does not mean I'll blindly buy these 2, right? So remember, the job of the scanner is not to tell you what you need to buy or sell. The job was, I can't analyze 2000 companies, it gave me a list of 2. Similarly, if you look at the short scan, it is not filtering anything for me. Can you see no stocks filtered in the scan? So this can happen that at times you might not get any results because nothing is matching with these conditions, or maybe your list might be a very small list. And the problem is, the smaller the list, the lower is the probability you might be able to find something which is in sync with your trade plan. Because now you saw that out of 2000, I only have 2 companies to look into. And if I analyze these 2, both of them, they don't match with my trade plan, no opportunity is available to me. So if you want that your list should be a little bigger list, because the bigger the list, the higher is the probability you might be able to find something which is in sync with your trade plan. Then you can see that in this scanner, I've given 5 different conditions. You will disable the third one, run the scan again. And now you can see instead of 2, I'm getting a list of 109 symbols. And similarly, if I go to the short scan and I do exactly the same thing, now instead of 0, I'm getting 3. So 109 plus 3, I have 112 symbols to look into. Now 112 is a very small number if you compare with 2000, and it can easily be analyzed, I'll say, in about half an hour, 45 minutes. But if you still feel it's a very big number, I want even a smaller list, then you can use different filters. Example, I can say that instead of cash market, I only want the symbols which get traded in futures. I run the scan again, and you can see from 109, now I'm down to only 23. So this is how you can make your list bigger or smaller by using different filters. Similarly, if I go to the screener section on this website, you have over 150,000 screeners available on this website. You can use any of these screeners to help you get your list of symbols. But remember, irrespective what scanner screener you're using, whatever results you get, you can never blindly buy or sell them, because like already said, scanner screeners, they don't tell you what you need to buy or sell. They only help you get a smaller list which you will have to manually analyze. Now in this example, you saw we got a list of 112 symbols. Now once you start analyzing these 112 symbols, there are a few more challenges which you will eventually face and realize. Challenge number 1 is, what you'll realize is that most of the symbols in this list, they don't have a quality demand zone or a supply zone on the lower time frame. And now the problem is, unless and until you have a quality zone, you can't plan your trade, because to plan a trade, I need a quality zone against which I can lean. And the reason for this is that all these 150,000 plus scanners we talked about, they are either based on conventional technical analysis or fundamental analysis, and that is why just because something is getting shortlisted does not guarantee that it will have a quality area available on the chart. And the second problem is that some of these symbols, even if they do have some quality areas, those quality areas might be far away from the current market price, due to which you'll have a longer waiting period, because unless and until prices they revisit those areas, you can't participate. And during that waiting period, whatever price action develops, it might even disqualify the trade setup for us. So these are 2 challenges we face when we are using scanner screeners which are either based on conventional technical analysis or fundamental analysis. And to overcome these challenges, I have also created 2 custom built tools. Again, before we talk about these tools, very, very important, these are not call giving or tip giving services. These are also scanner screeners. Only difference being that these 2 scanner screeners are purely based on the demand and supply zones. Now, if you want to go through more details of these two tools, you can look into the description. You have the link to the walkthrough videos of the alerts and the screener, but I'll still touch upon it broadly so that you can understand how both of them they work and what is the difference between the two. So the way the alerts they basically work is that you there are two ways to do it. One, when you subscribe to alerts, we have a predefined list of symbols that our screener is looking into, and on our Telegram channel we provide you alerts for it. Plus you also get access to the alerts indicator, wherein you can create your own custom list with your own custom time frames. And what the alerts will do is that as soon as you have a formation of a demand area or a supply area, it immediately notifies you during the live market. Now, for the alerts, we also have demo channels. If you want to experience those demo channels, you can join them. Again, the walkthrough videos will help you understand how you can join those demo channels. But I'm showing you the example from the NSE demo channel for the 25th of October, which is Friday. So you can see at 11:15 we got an alert for a particular symbol. We have a rally based rally zone on the 5 minutes time frame. This is the proximal value. This is the distal value. So that's your 5 minutes alert. That's your alert on the daily time frame, alert on the 5 minutes, alert on the 5 minutes, alert on the 15 minutes, alert on the 15 minutes. So you can see as and when these demand and supply areas are getting formed, you immediately get these notifications live that on this particular symbol, on this particular time frame, you have a demand zone formation or a supply zone formation. But remember, these are not calls or tips. It is only telling you where these zones are getting formed during the live market. Once you get to know where these zones are getting formed, you will have to match these and qualify these zones with your trade plan. Only if they qualify based on your trade plan, they can be your opportunities. Otherwise, they have no meaning for you. So that is what alerts does. You can create your own list and you keep getting those notifications during the live market as and when these zones are getting formed. Now, the second tool we have is called as the screener. Now, what we do in the screener is that we again give our list of symbols. Like in this example, you can see I've given about 40 symbols. And then I've given the condition that my proximity percentage is 1, which means when my current candle is within 1% to a demand area or a supply area, I want you to shortlist that. Now, let's assume my example, I only plan long trades. So it is telling me these are the only 3 symbols which are closer to some demand areas. So example, if I take the first one, LTIM, you will see that my current candle will be close to a demand zone, and that is why it got shortlisted for me. So you can see out of 40, if I only want to look for long trades, I can only analyze these 3 because rest of them are not closer to demand area. So it is also time saving. Plus I'm only getting the list of symbols where I might get my entry very, very soon. So if I take the other example, let's say Ultra Cement. So here also I'll be having a formation of a demand area and my current candle should be close to it. So you can see we have a demand area, current candle will be within 1% to it. That is why it got shortlisted for me. Plus because I've created my list now, I can also check it on different time frames. Example, if I go to the weekly, now you will see I'll get my results based on the weekly time frame. Let's wait for a few seconds. So can you see now I have my results based on weekly time frame. If I go back to daily, I have it based on daily time frame. So that is what the screener does. So that's the difference between the two, that the alerts are based on the zones which are getting formed during the live market, and the screener is based on the current candle with getting within that proximity range to a demand area or supply area. That demand supply zone might have formed today or a day ago or a week ago or a month ago, a year ago, decade ago, doesn't make any difference. As long as you'll be in that proximity, it will shortlist for you. So again, I'll add, you have a number of scanner screeners available to you. I showed you over 150,000 on one single website. These two are purely based on demand and supply. Process can also be as simplified as, I don't want to use these scanner screeners. I want my small list. I'll only be analyzing my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that list. But obviously the more in sync you're with demand supply, the higher is the probability that on a smaller list of symbols, you might be able to find something which is in sync with your trade plan. So you have to decide how you want to get that small list. So step number 1, we already got to know our time frames. Step number 2, we got our list of symbols. So what we need to do now, we need to analyze them one by one. Whatever matches with my trade plan is my opportunity. Whatever doesn't match with my trade plan, simply skip it. So let's assume the very first one was ABC. So what are we supposed to do now? On ABC, we need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, my lower time frame is daily. So we'll go to the daily time frame, and on daily time frame, we need to identify a zone. By zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So now the next beauty and good news for you is that when it comes to the analysis, we also have an indicator which is called as demand supply zone indicator, where you don't have to identify the zones now. The indicator does it automatically for you. And yes, you can also try this indicator absolutely free for 7 days. Now, how you can take this 7-day free trial, we have the link in the description to a Google form. So all you have to do is just fill that Google form with the correct information. Most important being your TradingView username, because if you're providing incorrect username, it will not get activated for you. It will get activated for that incorrect username. So you have to provide your TradingView username, and once we get this information from you, within 24 hours, it will get activated for you. You can try it for free for 7 days, whether you do demand supply methodology or whether you want to use these demand supply areas with whatever strategy you're doing as a confluence. You can try it out. So do ensure you take advantage of this free trial, which we just recently started in the last X number of years. So we were not providing this. We were only providing access to our demo version, which only used to work on one time frame. But yes, now you can have a free trial for 7 days. So do ensure, if you want to try it out, you can fill that form with the link is available in the description. So yes, coming back to step 3, we have to identify the zone. Now I don't have to do it myself. The indicator is telling me that this is where we have a rally-based rally zone. So we'll mark that zone for us on the chart. So now I have identified a zone. My step number 3 is complete. Now, after doing my step number 3, what is the next step? Do we have a zone available? The answer is yes. Now, just because you have a zone on the chart does not mean you can blindly trade it. Now we'll have to qualify it, and for qualification, 2-step process. And step 1 will qualify based on certain conditions. Step 2 will qualify based on the boosters. So the first thing we check is that, can this zone be a case of level on top of level? Now, why do we start with the level on top of level? The reason for that is because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different zone. So if that shift is required, that is the first thing we should be doing before we proceed ahead. That is why we first start with level on top of level. Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So the first thing we understand here is that to be a case of level on top of level, my lower time frame zone has to be completely inside the intermediate. Only then it can be a case of level on top of level. If it is not coinciding, it can never be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And in this case, my intermediate will be weekly, and you can see on the weekly our intermediate time frame zone is a little lower, which is right here. So my lower time frame zone is not coinciding. So I'm just using a different color to differentiate between the two. So the one in green is my lower time frame zone. The one in pink is my intermediate time frame zone. So is my lower time frame zone coinciding with the intermediate? The answer is no. And since it is not coinciding, it cannot be a case of level on top of level. So level on top of level not applicable. This zone is not because of a gap, therefore gap rules will also not apply. Pivot non-authenticity, we only apply to drop-based rallies and rally-based drops, so this is also not applicable. And not an unstable equilibrium structure, because for unstable equilibrium, the leg out should have gone below the basing, which is not happening in this case. So none of these conditions are getting applied, and if none of these conditions are getting applied, it cannot be disqualified, because to be disqualified, first they need to be applicable. Then there are two possibilities, either qualified or disqualified. If they are not getting applied, the zone cannot be disqualified. So is the zone qualified for us? The answer is yes. So now that I know that this is a qualified zone, next thing is our booster scoring. Let's start with the boosters. First one is freshness. The zone is definitely fresh, gets a score of 3. Now, talking about strength, I have talked about this many times because I plan MIT trades. So for the single leg out, I also like to keep it as good. If I change it to explosive, now you will see the indicator is not identifying it. So we know it's not an explosive move, but if it is, it is definitely a good move. So for good move, I'll give it a score of 1. Now, this is also a very beautiful example as we move on to our curve analysis, and you'll get to know why. But let's get done with these two boosters first. So time at the zone, we only have two candles, gets a score of 2. Reward to risk ratio we are taking as an assumption. Now talking about location, now we have covered such cases many times that once we go to the higher time frame, we do have demand areas, but we don't have supply areas. And what we do in such cases, we take the most recent pivot high as a reference point and draw our curve. But the problem here is that this monthly candle has not yet completed, right? So we still have about, I guess in this month we have how many days? 31 or 30? So we have 31 days. So we have another 4 days before this candle completes. And what can happen is that during those 4 days, prices can move up and this red color candle can get converted into a green color candle. So we understand that since this is still a live candle, even if I take it as a pivot high, during the month itself, prices can move up and it can create new highs. So as of now, I can't even take it as a pivot high because this candle has not yet closed. So this is a symbol which is making all-time highs. So if I go back to my rule book and let's search for all-time highs, right? Because the candle has not yet completed, things can change before the end of the month. We'll have to consider the all-time high rules. Now, the all-time high rule says that for a script making all-time highs, first and foremost, we don't plan a short trade unless and until we have a weekly supply area. So anyhow, we are planning a long trade. We are okay with this one. Next, if a script is making all-time highs or the trend will be considered as an uptrend, you don't even have to do the trend analysis. And next, because the script is making all-time highs, we don't know where supply will form and we can't do our curve analysis even by taking it as a reference point. So we will be considering all locations as equilibrium location, right? So these are the rules which will have to apply. So because I'll have to apply these rules based on that, talking about the location will be taken as equilibrium, which will be a score of 0. Trend will be considered as an uptrend, which is a score of 0.5. Move from the zone, definitely we already have a move. Let's draw this. So we already have a move which is more than 4:1, therefore gets a score of 2. Now talking about level on top of level, not a case of level on top of level, not even coinciding. We have already looked into it. But for trap, I'll say I can still give it a score of 1. And the reason for that is if I take a horizontal line wherever the zone is, you can see almost this area has beautifully acted like resistance, acted like resistance, acted like support, acted like resistance, acted like support, acting like resistance, acting like resistance. So we do have a very clean area of support and resistance. But now the problem is wherever we are buying, you understand by the time prices will be coming into the zone, people will be looking into this area, support and resistance, and most probably they will also be buying. So I'll talk about it moving forward as well, right? But otherwise, I'll say that yes, since we still have a zone, not a single point, so as soon as we start going a little deeper, it might work like a trap, for which I am okay with giving it a score of 1, which still makes it as a type 2 or a type 3 trade for us. So yes, going with the overall scoring, we have a high quality zone but low probability setup, which is going to be a type 2 type 3 trade. Now if I talk about myself personally, when I was doing the analysis for this, you saw that we do have a weekly zone here, inside of which we also have a daily zone, you can see, which is right here, a rally based rally, which the indicator is marking for us. Plus, if I take this lower zone, my stop loss is also at a very good location, even on the higher time frame. You can see I have my higher time frame daily, sorry, monthly distal line, and my stop loss will come below the monthly distal line as well. So looking into these conditions, personally, if I want to plan my trade, I'll be more inclined towards this lower zone versus the upper one. And this will also have a higher probability of working like a trap because, like I said, this is where everyone would be buying. So I would prefer to be a little lower, from that area, not exactly at that area. So yes, for the analysis part, we will still stick with the one above. But me being a little conservative trader, if I wanted to plan my trade, I would have gone to this lower area because it will give me few more advantages, a better case of trap. Plus, I'm getting the support from the weekly time frame as well. Plus, I'm getting the support from the monthly time frame as well. So yes, I'll be more inclined towards the lower one, but my stop loss would be below this, which would be the weekly and the monthly distal line. But anyways, going back with the analysis, this is qualified for us, type 2, type 3 trade. Let's get back. So yes, now no matter how high the quality or the probability, any trade can be a stopped out trade. So we'll have to be ready for the worst case scenario by doing our proper position size calculation, which is part of our risk management. Now, whenever the prices are back, we'll have to re-verify because markets are not static, markets are dynamic, conditions are changing almost every other second. Before entering the trade, we need to re-verify it. Does it still qualify based on my trade plan? If the answer is yes, you place your order based on the entry type, and once your order has been executed, the last step is your trade management, where step 1 is 1:1. We make it as a break-even trade, and after that, if we get the opportunity to trail onto it, we'll start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule-based. And before we move on to the questions I have in the chat box, let me also add, if these sessions are helping you, do hit the like button. If you have your friends, family members, or if you are into some trading groups, do share my videos, these sessions, my course content with your friends, family members who are into trading. And now that we also have that 7 days free trial offer, you can also share the link with your fellow traders. And if you're on some trading groups, you can also share there so that people can take advantage of it. So let's see what we have in the chat box. Can we say if the prices are in the zone for too long in type 1, then the probability for getting stopped out is high? It's not necessarily the case. Prices can spend n number of candles in the zone and still the zone can work out, right? So it's not that if it is in the zone for a longer period, it will always get stopped out. At times, yes, it can get stopped out. At times, yes, it can also go in your favor. But the if you think about it logically, when you've already decided, okay, this is the kind of risk I would like to take, even if it is spending more time into the zone and you want to hold on to it, why not, right? But yes, you can use other confluences if you feel that yes, the markets might go down because the demand area on the market is pretty far away, and since the prices are spending too much time, maybe I want to exit. Yes, you can have such rules. In fact, I have had students in the past which had such rules, right? They would say if the prices will remain in the zone for X number of candles, I will close my position, right? So yes, if you want to have those kind of rules, you can even have those kind of rules. Nothing wrong with that. What do you think is the reason for crash? Is it because FIIs are selling and booking profits? Now, this is a very interesting question. Now, if you think about it, right, let me put it the other way around. If you're saying, is it because the FIIs are selling, right, and booking profits? So now my question to you is, if they are selling, somebody is also buying. Would you agree to that? I'm pretty sure everyone will say yes, because in trading, we know if somebody is selling, somebody has to buy. So if let's assume if FII sold X amount of shares or X $1 million amount of shares, somebody also bought exactly that X million amount of shares as well, right? So this is what the problem is. When we look into the news, we say, okay, FIIs are buying or FIIs are selling. But if you think about it, if somebody is selling, somebody is also buying. So the number of buys and sells are exactly the same. It's not that 100 shares were sold, but only 10 were bought. That cannot happen. If 100 shares were sold, 100 shares were bought, right? So your buying and selling is always exactly the same. But the problem is, somebody who is selling 100 shares, are they willing to sell even more, which is more supply? Or people who are buying 10 shares, are they willing to buy even more, maybe willing to buy 10,000? That means demand is more. So this will get depleted and eventually we will move up, because we still have another 9,990 shares which somebody still wanted to buy. So again, FIIs buying, FIIs selling has nothing to do. It has to do with whether there is more demand or whether there is more supply. Buying and selling is always exactly the same. Alright, so do you not participate in HIT trades? No, I only do MIT trades. I used to do HITs, DITs, WITs, everything, but now I am doing more laid back kind of trading. So now 100% of my trades are MIT trades. Alright, so what is your choice of curve marking? It's wick to wick or body to wick. See, the zone always starts from the wick, and that is what I do, irrespective whether I'm doing the curve analysis, whether I'm doing the zone marking on the lower time frame. I always prefer to use wick to wick method. See, when we start with body to wick method, we are doing it to be a little bit more, I'll say, bargaining with our zones, right? So to have a better pricing, but eventually you'll realize the more you bargain, the more number of trades you will be missing. And eventually you will see, once you start getting very good with identifying quality areas, you will have no choice but to shift from body to wick to wick to wick method. Otherwise, you'll miss a lot of trades. Have you tried to become a SEBI registered RA, or will you in the future? See, the fact is, I'm not giving recommendations. So since I'm not giving recommendations and I'm not even planning to do it, it's not required, because somebody who is giving recommendations, those are the people who require it. I'm only into education part, and that is also where I'm not even sharing the name of the symbols for you. So it is purely educational based, for which it is not required for me to go through the SEBI registration, right? Perfect. Please do watch a chart for NG. So we'll not be getting into specific charts like natural gas or something like that. In these sessions, I only share my examples, and even the examples that I'm sharing with you, I don't disclose the name of the symbol, so that becomes irrelevant. And that is how these sessions will be. Like already said, these sessions are focused on education. They have nothing to do with the recommendations, and that is how we'll be going about. Okay, and for scalping, can we use the demand supply methodology as 15 minutes will be for location, 5 minutes, 1 minute will be for refining and entry. So, and see, yes, all those things can be done. But if you think about it, let's say if I talk about the NSE market itself, now if you're taking your lower time frame as a 1 minute time frame and you start planning your trades on that, trust me, even if you get a 2 is to 1 or a 3 is to 1 or a 4 is to 1 or a 5 is to 1, even on a 5 is to 1, probably you'll be giving 30 to 40% of your profits as commissions. So yes, on the face of it, it looks really nice. I can get a 5 is to 1 or a 6 is to 1, but when you sit and do the calculations, you will see the zones are very narrow, and since the zones are very narrow, your 2 is to 1s, 3 is to 1s are also very small moves, which eats away a lot of profit as your commissions. So that is also another reason why, somebody was asking that you don't do HIT trades. You will face all these issues once you start going to smaller time frames. Plus, when you're, let's say, trading small quantities, you might get your fills very easily. But when you start trading bigger quantities, the challenge will also be with your fills. And now what is going to happen? Trades which go in your favor, you might not have a 100% position and it will hit your target, but your stopped out trades will always have 100% positions. So which also spoils your reward to risk ratio, that since let's say you got a 4 is to 1 but you only got 50% fill, so a 4 is to 1 converts into a 2 is to 1. But if it is a stopped out trade, then it's a 100% position, because without giving you a 100% fill, it can never go to your stop loss. So those are the challenges which you'll realize when you practically start doing it. And then you will realize that one, you'll have to be in front of the computer the whole day, plus all these challenges you're facing. Then eventually you might move from time frames which are very small to maybe a little bigger time frames. But yes, if you want to try it out, maybe you are trading with some very heavily discounted brokers and you want to still try it out, yes, you can try out those things. But personally, it doesn't match with my personality style. That is the reason I don't do it. Can you explain with an example of the below? So, I mean, I'm not able to get which one you're talking about. You're talking about the commissions which I was just talking about. Price comes to the zone from the higher time frame, demand supply when the price comes back to your zone after hitting. Okay, so you're talking about, see, now the problem here is it will be a little bit challenging for me to find an exact example on the chart, but let me just do the annotation for you. So this is how we are planning our trades. Let's assume we start with the uh, higher time frame. So on the higher time frame, we'll have our very high of the curve, we'll have our very low of the curve, right? And now what we do is, on our lower time frame, we identify our zone. So let's assume that on the lower time frame, I have a rally based rally, and that is where I want to participate, right? And now if you look at the curve analysis, maybe we are planning somewhere low on the curve. Now, the reason we are planning this trade is because we are anticipating, once the prices they come into this demand area, from this demand area it can continue all the way to the supply. Now from this supply, two things can happen. Either the supply can get violated eventually, prices move higher. That is one scenario. The other one is that from the supply holds and the prices they start coming back, right? So these are the two things which can happen. But yes, because prices have already moved up, maybe you were trailing onto it, or maybe you've already booked your profits and you're done with the trade. Now, many times what can happen is, prices they don't come back to our zone, they just keep moving up. They hit this higher time frame supply zone and then start reacting from there. Now the problem is that prices are coming down from a bigger time frame supply. So the analogy I give here is that the lower time frame, you can consider it as a kid, and the bigger time frame, you can consider it as an adult. So when an adult is pushing something down, what is the probability the kid can hold it? That probability is very low. And that is why when we see such scenarios, they have lesser probability. And now if you think about it in terms of demand supply, now if you think, let's say if I talk about a WIT trade, this is going to be my 60 minutes chart, and this is going to be my weekly chart. Now just imagine the number of orders that can get filled in 60 minutes versus the number of orders which can get filled in a week. So we understand, the bigger the time frame, the bigger the the demand or the supply can be. So that is why when prices are moving down because of this big supply, that small demand might not have a very big weightage, right? So that is why it might easily get violated. And that is why we have the rule in the rule book that if we see such scenarios, let me just show you in the rule book. Okay, it will be in the additional rules. There it is. When the prices come to the zone from the higher time frame demand or supply zone, when the prices come back to the zone after hitting the very low or very high of the curve, the probability of the trade reduces. And I just gave you the reason behind that, because it is much bigger demand or supply from where the prices are reacting versus where you're trying to participate. So as a conservative trader, what we should be doing, we should be skipping such trades. We should not be taking such trades. Now, as an aggressive trader, if you want to take such trades, yes, we would like to some positive factors. Now, what are those positive factors? First, you do ensure that you have the required RR, because if the RR is missing, anyhow, we would not like to participate. So that's your very first condition. And the second one is, because I know the prices are coming down now from the weekly time frame, I would like to have extra probability. So what I want is now the location of my lower time frame zone should be the best location on HTF plus one, which means when I'm planning the trade, it should not be the very low of the curve. It should also be the very low of the curve of my higher time frame plus one, which is the monthly. So now on the monthly time frame, if I'm very low on the curve, I understand from the weekly prices are coming down to a monthly demand. So from monthly, yes, probabilities prices can move up, and that is why I want to have that extra probability by going to one time frame higher. Now if I look at the same time frame, both of them will have the same weightage, so that is why we want a little extra weightage, and that is why the condition says I would like to see from the HTF plus one. Now, is it always HTF plus one mandatory for me? That is my rule, right? If you want, it has to be the higher time frame itself, at least it will still have the same probability, be it, right? Those modifications can be done based on your preferences. I would prefer it to be HTF plus one. So I hope that helps you understand this. Now, like I said, it's not possible for me to find an exact example on the chart, but at least I guess showing you those annotations would have helped you understand the concept behind it. And also I talked about bigger time frame demand, smaller time frame supply, or whatever. It will be a huge difference between the number of orders, which reduces that probability of that trade setup. All right, so I guess that takes care of all the queries that we had for today's session. So thank you so much for joining in. I will be seeing you now next Sunday. Till then, trade safe. Enjoy your Sunday evening. Take care. Bye bye.